Hey everyone, welcome back to the channel. If you've been following the stock market recently, you've probably noticed that things are a bit interesting. While the market is still climbing, there's growing concern about a possible downturn, and a lot of investors are wondering if a stock market crash could be just around the corner. Now, I know market crashes are no one's favorite topic, but it's super important to be prepared in case it happens. In fact, today we're diving into everything you need to know about a potential stock market crash and, more importantly, what you can do to protect your investments and your future. Stick around because I'm sharing strategies that I'm using to secure my own portfolio, and trust me, they're going to help you too. So let's get into it. So here's the situation. The stock market is still on the rise, but investor sentiment is starting to shift. A recent survey shows that 34% of US investors are feeling bearish about the next 6 months, meaning they think the market might drop soon. That's a noticeable increase from 29% just a week prior. So what's going on? Could a market crash really be on the horizon? Well, while no one can predict the future, there are a few indicators that suggest a potential downturn might be looming. One of the most notable of these is the Buffett Indicator. You've probably heard of it, but let me explain what it means and why it's making waves. The Buffett Indicator is a metric that compares the total market capitalization of all publicly traded companies to the US gross domestic product, GDP. In simple terms, it tells us whether the stock market is overvalued or undervalued. When this ratio is high, it means stocks might be priced too high relative to the economy. Warren Buffett himself has called this indicator a great tool for spotting potential trouble in the market. Back in 1999, when the ratio hit around 200%, Buffett warned that the market was playing with fire. And guess what? The dot-com bubble burst not long after. Now, here we are in 2025, and the Buffett Indicator is sitting at 203.51%. That's even higher than it was back in 1999. So, does this mean a crash is definitely coming? Not necessarily. But it's a pretty strong signal to stay cautious. Here's the thing. Stock market crashes are a normal part of the market cycle. They happen, and they're almost always followed by recoveries. The key is not to panic. While it's tough to predict exactly when a downturn might hit, there are things we can do right now to protect ourselves and our investments. So, what am I doing to safeguard my investments? Let me share my 3-step strategy for protecting my portfolio, and I encourage you to follow along. Step 1. Build or strengthen your emergency fund. This might sound basic, but it's crucial. The stock market might take a dive, and when it does, your investments could lose value. But if you've got a solid emergency fund, you won't have to panic and sell your stocks when the market is down. Here's the deal. An emergency fund isn't just for rainy days, it's for when life throws those unexpected expenses your way, like medical bills, car repairs, or even a sudden job loss. Ideally, you should have enough savings to cover at least 3 to 6 months of living expenses. If the market crashes, this gives you the breathing room to weather the storm without tapping into your investments. Step 2. Review your investments regularly. Now this is key. Over time, the market changes and companies evolve. What was once a great investment might not be the best choice today. That's why you should be checking in on your portfolio, not just once in a while, but regularly. Here's what to look for. Does the company still have a strong competitive advantage? Is it poised for growth in the future, or is it struggling to keep up? A company that seemed solid years ago might not have the same staying power today. The leadership team is also something you need to keep an eye on. Strong, visionary leadership is often what separates good companies from great ones. Step 3. Keep a long-term outlook. When the market's volatile, it's easy to get caught up in the panic. But history shows us that, despite all the crashes, the dot-com bubble, the 2008 recession, the COVID crash in 2020, the market has always come back stronger. Let's take a look at some numbers. Since the year 2000, the S&P 500 has gone up by more than 300%. Even if you invested $10,000 back in 2000, you'd be sitting on nearly $41,000 today. And that's after surviving some of the toughest crashes in history. The key takeaway here is don't panic during short-term dips. If you stay focused on the long-term horizon, the odds are in your favor. Here's a bonus tip for you. Diversify your portfolio. It's one of the best ways to protect yourself from big losses during a downturn. Don't just rely on stocks. Bonds, real estate, and other types of investments can help cushion the blow when the market dips. By diversifying, you spread your risk across multiple asset classes, so if one part of your portfolio takes a hit, you're still covered by other investments. Diversification can make all the difference during uncertain times. Now, here's a question I get all the time. What if the crash doesn't even happen? What if the market keeps going up? Well, that's actually a win-win for you. If you've been preparing for a downturn but the market stays strong, you're still on track with a solid portfolio and an emergency fund that's ready just in case. Ultimately, the key is to stay calm and stay prepared. You can't predict the future, but you can control how you react. By following these strategies, building your emergency fund, reviewing your investments, maintaining a long-term outlook, and diversifying, you're putting yourself in a great position, no matter what the market does. So, let me know in the comments, what are you doing to prepare for potential market changes? Have you started reviewing your investments or building your emergency fund? Drop your thoughts below, and if you found this video helpful, don't forget to hit that like button, subscribe, and turn on notifications for more tips on managing your money and investments. Thanks for watching, and as always, stay smart and stay financially strong. See you in the next video.